Hi, everyone. Welcome to this Nadex webinar on an introduction to technical analysis. Apologies there. I started this and then looks like I'm having some slight technical difficulties with the sound. I think I have sorted through it. If on the right-hand side of your screen, just a quick housekeeping item, if you can hear me, click on that little question mark with a 1 in it and say, hey, you're coming through loud and clear. And just let me know that you can hear me. I would appreciate that. And this is an interactive session. If, as we're going throughout the day, you have any questions and I'm cover something too quickly or I'm not clear about something, by all means, please type it in. I will do my best to answer the questions as I go. However, if I don't get to your question, I'll try to look back and get to it at the end. So again, if everything is coming through clear, please just type it in, say, hey, you're all good, and I would appreciate that. And yeah, I'm coming through fine. Fantastic. I appreciate that. Oh, perfect. Thank you, everyone. Okay. So sometimes you just have to solve problems on the fly. This is how it goes. All right, an introduction to technical analysis. This is a Nadex webinar. And before I jump into it, let me quickly share this disclaimer. These webinars, as are all of our webinars, are sponsored by the Nadex Compliance Department. Trading involves risk and may not be appropriate for everyone. Any trading decisions you make are solely your responsibility and at your own risk. And this is an educational session. Please do not construe anything I say as a buy or sell recommendation. I'm doing this for your education purposes. Now, just a quick little bit about me, if you're not familiar, haven't joined some of our sessions before because we have so many new people who have come into the exchange lately. My name is Todd. I am the head of education at Nadex. Just a little bit about my background. I joined Nadex 2 years ago, and it's been the culmination of some extensive experience in the financial services space. Now, I started my career decades ago at Anderson Consulting, if you even remember who they are. But then I moved to Chicago, traded on the trading floors for 8 years, and then I moved into the exchange and brokerage space, working for Eurex, which is a Deutsche Börse company out of Frankfurt, Germany, Boston Options Exchange, the New York Stock Exchange, and then E-Trade before I came over to Nadex. I did study at UCLA. I got both my BA and my MBA from UCLA. Now, what are we going to be covering today? And in this session, I am going to do a little bit. I'm going to spend a couple minutes on who is Nadex. And there's a reason why I do that, particularly for this session. It will become a little bit more clear when I discuss who Nadex is. And then I'm going to get into technical analysis. I like a little bit of a history lesson. The history lesson is, where the heck does this stuff even come from? Who thought it up? And what were they thinking when they thought it up? And I want to go through those concepts. But once you go through those concepts, it's more important to really understand is, why do you even care about it? And that's why you're ultimately here. Then we are going to go through some basics. I mean, this is an introductory session, and I'm going to go through how to read candlesticks and a candlestick chart, how to look at things like trends and reversals and support and resistance. If these are terms you're not familiar with, you will be at the end of the session. And then I'm going to talk about indicators and drawing tools. And you're going to ask, well, what's the difference between all that? And I'll explain that as well. And then I will get on the Nadex platform and demonstrate. I am a big fan of doing practical demonstrations. My mother was born in Missouri, or Missouri, if you're from there. It is the show me state. And I like to show people what, because I think that that's a way to really connect the concepts and then have it displayed in very in context in a very practical way on what you can do and how technical analysis can potentially help you. All right, so that is our tee up. Again, I want to remind you that little question mark on the right hand side of your screen. If you've got any questions, fire them away. I'll do my best to answer them as we go and to address them at least by the end. I am not going to spend too much time on who is Nadex, but it is important to this concept. And so I'm just going to kind of breeze through this a little bit. And I do this again because there are so many new people coming to Nadex markets, and it helps just to put it in perspective a little bit. Nadex is an acronym for North American Derivatives Exchange. It is a regulated exchange. And the reason I emphasize that, we are regulated by the Commodity Futures Trading Commission, the CFTC, another wonderful acronym. The reason I emphasize that is because a lot of people come to Nadex for our short-term, short-duration binary options contracts. There are not many regulated. In fact, I think there are only 3 regulated binary options exchanges in the United States. One of them doesn't do much of anything. The other one does some different types of markets. Almost all of the volume in binary options in the regulated space in the United States is at Nadex. And if you hadn't caught it, some very exciting news recently, but Crypto.com has entered into an agreement to acquire Nadex, which we are looking to hopefully close early this coming year in 2022, in which case Nadex will be owned by Crypto.com. Exciting times, a lot of new things coming to Nadex. Now, what is it that Nadex offers? And this is why retail traders are coming here, is we design contracts specifically for retail traders. Something that the broader markets are rushing to catch up with is that there are a lot of retail traders out there, small folks who don't have thousands or tens of thousands or hundreds of thousands or even millions of dollars, but they want access to the markets. You could have hundreds of dollars, tens of dollars. People want access to price action, and Nadex has been offering that for a decade. Nadex offers retail products with a very low cost of entry, but the cool thing about Nadex products is that they all have very clearly defined risk before you get into the trade. So you cannot blow up more than your account. You can't lose more than what you put into an individual trade. There are no surprises. Once you're into a trade, there's nothing like the concept of margin calls. They simply don't exist at Nadex. So we've got these very clearly defined low dollar, low notional value contracts, and people come here to trade binary options. We also have knockouts and call spreads. If you're not familiar, we do sessions on all of those. Now, the reason I like to bring this up at this session is that the way that a lot of people access these markets is they use technical analysis to try to find entry and exit points. So again, when some of these words I might be using you might not be familiar with, but when we get into it, technical analysis does play a hand in a lot of play a part in a lot of the way that people access our markets, trying to identify when they might want to buy or sell something and when they might want to get out of the position, whether it's to lock in a profit or to limit losses. So that is what Nadex is. Oh, you know what? One more thing. Because there's so many new people, and sometimes people who've been around for a while aren't familiar, if you have a live account, you have your own personal refer a friend link. This is a program we run where if you invite a friend using that link and your friend uses that link to sign up for a Nadex account and they place 5 trades within the first 30 days of applying for an account, we'll give them $100 and we'll give you $100. You get $100. You get $100. Everyone gets $100. It's because a lot of the retail traders, they like to trade with friends. And it's nice to have someone to bounce ideas off of and to talk through. Sometimes, 2 heads are better than 1. So we want to encourage that. You can do that with up to 10 of your friends, in which case you could end up having $1,000 in your account, and 10 of your friends would each have $100, and you all could potentially trade together or talk about it together. Getting into technical analysis, let's talk about where technical analysis comes from. And I'm going to throw out a name. You may or may not know who he is, but his name is Charles Dow. He lived in the late 1800s. Now, if you don't know who he is, he did some pretty amazing things in his short lifetime. The first thing he did, 1882, Charles Dow founded Dow Jones and Company. That might sound familiar because you hear Dow Jones quite a bit. We're going to talk about that in a second. But he also started up a newsletter. Back in the day, the way that it worked is companies paid journalists to write articles about them. And Charles Dow didn't want that type of a relationship. He wanted unbiased news. He wanted, and so he built a newsletter. That little newsletter he built, it was an independent newsletter that wasn't sponsored by the companies looking to get people to promote their stock. He was trying to do independent analysis. That turned into the Wall Street Journal. So I think we're all familiar with the Wall Street Journal. Now, you've heard Dow Jones with Edward Jones. So Charles Dow and Edward Jones. Edward Jones was a statistician, a mathematician. And Charles Dow wanted a number. He needed a number, and we're going to talk about why he needed a number in a second. But he wanted a number to take a look at the broader market. And so he and Edward Jones created the Dow Jones Industrial Average. It's a mathematical calculation. We all look at the Dow Jones Industrial Average, and now we also look at other indices that have been built since then, like the S&P 500, the Nasdaq 100, the Russell 3000. There's all sorts of indices, but Charles built the Dow Jones Industrial Average with a purpose. And what Charles Dow did is he had a theory about the markets. He had an idea that you could understand the markets, right? And he needed to understand the markets. He built these principles to understand crowd behavior, to analyze market behavior, to try to determine what was going on in the market. And it all has to do with charting. And we're going to talk about what that theory was in a second. But it had to do with charting, and it's Dow's theories on how the market works, or the way that he perceived the market to work, set the foundation for what has become technical analysis. So people often refer to Charles Dow as the father of technical analysis. A fun little side note, a little bit of a history lesson there. I always find it interesting. Now, what were the concepts that Dow really put forth? Now, I'm not going to go through all of the concepts of Dow theory, but I'm going to pick out the ones that are relevant or that are really salient. And the first of which is that markets are efficient. Now, what does efficient markets mean? And what Dow put forth is that anytime news comes out, that news gets factored into the price of an asset, whether it's the price of a stock, the price of an index, whatever that news is, everyone gets that news and it immediately is in the price. So if it's really good news and it's going to be accretive for a company, you'd see the stock price go up, and the price would move based upon that news. But then once the news is out, the news is the news, and markets are efficient. They are digesting and assimilating all of that information, so stocks are fairly priced at that moment in time. Now, if that's true, you can take the price of a stock or of an asset and you can put it on a chart. You could put a dot on a chart and say, at this time, this was the price. And then you could plot over time the movement of price on a chart, and that patterns would begin to form. All right, and that's what Dow put forth. That is his Dow theory, was that you would take the price, put it on a chart, and that you would see these patterns form, and that the price of an asset then would really, that what would drive the price of an asset fundamentally is simply supply and demand. If there are more buyers than sellers, the price will go up. If there are more sellers than buyers, the price will go down until you find an equilibrium where supply and demand matches. And then if all news is factored in and the only thing moving stocks is supply and demand, then you would have these trends that you can see as buyers step in, and then the trends would shift. The trends would shift when supply and demand shifted, and that you would see these patterns and that they would be repeatable. Now, why do you care about what Charles Dow had thought? And the reason is, if you use technical analysis, the thought is that you could understand that crowd mentality, understand or identify these types of patterns, and that you might be able to take advantage of price movement by reading the charts. Right? And so you're looking to identify. What are you looking to identify? Well, you're looking to identify trends. You want to see, are there more buyers than sellers? Is the trend going up? Are there more sellers than buyers? Or is the trend going down? And do you want to be able to try to participate in that price movement because you can see what's going on and what you think is going to happen? Not only are there going to be trends, but there might be times where you could identify a change in trend, a reversal. So when we say trends, it's trending in one way. A reversal would be it stops, turns around, and goes the other way. Sometimes reversals are called retracements. In the industry, we have a saying. It's called the trend is your friend. So if you see a trend going, go with the trend until the trend changes, and then make a decision that the trend's going to reverse or retrace. You could potentially see these patterns, identify them, and it could help you in making trading decisions. And it could help you get into a trade looking to make a profitable trade. It could also help you if you were wrong and you read the chart wrong, get out of a trade and say, oops, I made a mistake. Get me out. I've got to reassess. So really, why do traders care about technical analysis is that you're simply looking for price changes to identify entry and exit points. You're trying to find, where might I get into a trade that would be profitable? Where might I buy it because I think it's going higher? Where might I sell it and take a short position because I think it's going lower? And where might I want to exit that position and take a profit? Okay, hey, I made a profit. Where do I want to take my profits? At some point, you've got to make that decision. Or stop your losses. I was wrong. Get me out of this trade. Let's reassess. It's doing something different. So that is why you care about technical analysis, along with a little bit of the history behind it. Now let's get into actually applying some of these. And again, I know there are so many new people, and some of these concepts are very basic, but we need to be certain that you're very comfortable and confident with the foundation, because then it just simply becomes more advanced. They're building blocks. Each little piece is going to help you get to the next step. At the foundation, I'm going to talk about candlestick charts. Now, there are other types of charts. I can show them to you. I'll show you, they display very similar, if not the same information. They just might display it in a slightly different way. Candlestick charts tend to be the most popular because I think they are the most intuitive. When you look at an individual candlestick, I've got two candlesticks here. You'll notice one on the left and one on the right. One is green, the other is red. I apologize to anyone who may be colorblind. Hopefully you'll be able to identify the difference, and to you, you'll be able to see the difference, which is why there are other types of charts that might help people see the same information, not necessarily using the color, because you might not be able to even see it. But we do have two candlesticks, but one on the left and the one on the right. Now I'm going to talk about an individual candle. Let's take a look at the candle on the left. The center, that block, that's called the body. This is called the body of the candle. And above the body is you have a wick, and below the body you have a wick. Right, now, it's the same for a red candle, it's just a different color. Now, does the body of a candle, the bottom of it tells you where in this time frame the price of the asset was when it opened. And the top is where it closed. Now, the reason I say the bottom is the open and the top is the close is that's because it's a green candle. If it's a green candle, it means it closed higher than where it opened. A red candle is the exact opposite. If it's red, it's red, it closed lower than where it opened. That means the top of the candle is where it opened and the bottom of the candle is where it closed. That is why we have red candles and green candles, to differentiate between, if it closed higher than where it opened, it's going to be green. If it closed lower than where it opened, it's going to be red. And then you've got the wicks above and below that give you the entire range during this time period. So, and does a candle have to have a wick? No. It could open, trade higher, and close, and the open is the lowest, and the close is the highest, in which case there would be no wick at all. So it could have one wick above or below. It could have both wicks. It could have no wicks. But we are looking at an individual candle. Now, I am going to talk about time frames, and I'm going to start moving us into time frames. But this is important. Each candle represents a certain time frame. I could be looking, if I set my chart up to give me 1 minute candles, each candle represents 1 minute of time, in which case I know during that 1 minute where it opened, where it closed, and what the high during that minute was, and what the low during that minute was. I could set it to 30 minutes, and that candle will then represent a 30-minute time frame. And then I know during that 30 minutes what the high, the low, and the open and the close were based upon the shape of the candle and its color. So you get a lot of information. You get 4 data points in each candle, and you get 4 data points in each candle, and each candle can represent whatever time period you want it to represent. It can represent very, very little time, 1 minute. It can represent 10 minutes. It can represent 30 minutes. It can represent a day. It all depends on what you want to see and what time frame, and we're going to talk about that in a second. The other thing is when you've got one candle, let's say I've got it set to 1 minute candles, the very next minute I'll get another candle, and over the course of the hour, I will have 60 candles, one for every minute. Hopefully that makes sense. So your time frames become really relevant on the time frame of each individual candle. If I'm choosing an hourly candle, then I'll get 24 candles for a day. 24 hours, there we've got 24 candles. Well, if the market were open 24/7. Hopefully that's pretty straightforward on just being able to read an individual candlestick. Now I've started to talk about time frames, and I'm going to overlay that with trends a little bit. So when we talk about time frames, are you looking at a shorter term time frame? Are you looking at a longer term time frame? And then that's going to set the question, what do I want to see with each individual candle? And then how many candles do I want to look at in order to try to determine a trend? So it starts becoming a little bit multi-dimensional. Sorry about that. I want to save it right here. So on the right-hand side, you can see a little chart, and you can see how there's some candles in there. And if I were just looking at this, I don't even know what time frame each one of those little candles represents. And I also therefore don't know the time frame of this chart. If these were hourly candles, this could be a day and a half. If these were minute candles, this could be a half an hour, right? We don't know what we're looking at. But if I looked at this chart and I were just looking for a trend, I might look at this and say, wow, it looks like it's in a downward trend. I could see on the left-hand side of the chart, it was higher. On the right-hand side of the chart, it was lower. So what I'm looking at right now is I'm seeing a downward trend. But the question is time frame. Time frame gives you that perspective. You need that perspective to understand what you're actually looking at. Because if I back this up, here's a picture of the exact same chart. All right, you can see I overlaid it right above and below. If I back this up to a longer time frame, well, now I could say, wow, on the left-hand side of the chart, it's lower, and on the right-hand side of the chart, it's higher. This actually looks like it's in an uptrend. So time frame, that concept of time frame really becomes important. If I'm looking at a much shorter time frame, I might be in a short-term downtrend, but this could be part of a longer-term uptrend. It's all putting it in perspective. So when we talk about time frames, there's 2 time frames that you need to really be considering when you build a candlestick chart or any chart. One is the time interval for each individual candlestick. What do I want to see? What time frame for each individual candlestick? And then it's How far back do I go? What kind of perspective do I want? The time range for the entire chart, because each one of those might give you different perspectives and might change your opinion on what's going to, what might occur. I mean, we're reading a chart here. So time frames become important when you are looking at charts and trying to determine trends. But that also gives you the concept of trends themselves. And that's what people are looking for. Is it a short-term trend? Is it a long-term trend? And you're just simply looking at the chart and trying to determine which direction the asset is moving generically. Now, let's talk a little bit about reversals. Now, I'm going to give you, when you look at candlesticks, there are so many different types of patterns that you might see out there. And if you go on the internet and you Google technical analysis patterns, you're going to see a ton of them. Now, what I can tell you is that the pattern that really works best is the pattern that works best for you. You're going to have to determine and find what you're comfortable with, how you like to use these, where you find success, what it is, and that's where you can also learn from others, which is why I encourage people to have people to bounce ideas off of and work with others. I'm going to give you two examples of a reversal. And we saw a trend, a long-term trend. Hey, it's moving one way or it's moving another. How would you know if it's going to change, and how could I identify that potentially earlier on a chart? So let's take a look at, and we're going to talk about a hammer, and we're going to talk about a hanging man. I'm just picking two examples. And the reason I want to show you just two examples is this just gives you an idea of the tip of the iceberg of what's out there for you to discover. Again, we're just trying to introduce some of these concepts. So let's first talk about a hammer. All right, and what you've got on a hammer, you can see there's two types of hammer. There's a green hammer and there's a red hammer. And the reason it's called a hammer is because it looks like a hammer. It's got the head up top, and it's got a long wick below. Notice there's no wick above, and it really kind of looks like Mario's hammer a bit. Okay, and now there are green hammers and there are red hammers. I will tell you that a green hammer is a stronger indicator, but a red hammer is still a hammer. Now, what are we looking at in a hammer? And we are in a downtrend, okay? You can see the trend is going, the trend is going lower. Lower, 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 and then we get this one candle that looks like a hammer. And really what, the other reason it's kind of called a hammer is, at this point, according to this candle, is sellers have become exhausted. They've hammered it as low as they can hammer it. And if you look at it, the way a hammer works is it opens, and this is why a green hammer is stronger. It opens and they push it down. They get this long wick down below. And the sellers run out of steam. Buyers step in, they push it right back up, and it ends up in this candle closing higher than where it opened, and you get this little hammer formation. And in a chart, you see seller, 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 seller. They sell, they try to push it lower, but buyers stepped in and actually got it to form this little green hammer, which would be an indicator of a potential reversal, and you'd start to see an uptrend. Now, it could open, push all the way lower, and then not quite close higher than where it opened, and you would still get a red hammer, but it's still a hammer, and it would still potentially indicate a potential reversal. Now, that's a reversal when you are in a downtrend. That is called a hammer. You're in a downtrend, and you see this particular candle form, you might be looking for a potential reversal. Sellers might have become exhausted. Now, a hanging man, it actually looks very much like a hammer, except the head might be a little bit small, the body might be a little bit smaller. So maybe it looks like a hanging man when you play Hangman, the game, if you're familiar with that game with words. The difference here is, in a hanging man, it's actually part of an uptrend, right? A hanging man, you're in an uptrend, it's trending higher, it's trending higher, it's trending higher, but then you get this formation, all right? And with a hanging man, oops, I clicked backwards. In a hanging man, a red one is actually stronger than a green one. But if you get this formation, it does indicate that there might be a potential reversal to the downside. So I'm just giving you two simple examples, and I chose these specifically because we talked about trends where you can identify a trend. Is it, and you're looking at a chart, is it going higher? Does it have higher highs? Does it have higher lows, as it's going up? Or a downtrend? Is it going down? Are you watching the price trend lower with lower highs? And it's got lower highs, lower highs, lower highs. As we go down, you can see it's forming lower highs. And then when might you see a potential reversal? When might that shift? And that's what you're trying to find. This is what you're looking for, is what technical analysis indicators, tools do you like to use that you find useful that help you identify potential trends and reversals that you could potentially then use as signals to enter or exit a trade. Now, a quick review on reversals. You've got the hammer, which is, it's a buy signal in a downtrend. You see a downtrend, you see a hammer, and it would be a buy signal if you saw that. Versus a hanging man, which you're in an uptrend, and it turns into a sell signal. You're in an uptrend, you get the hanging man, and it's a sell signal that you're potentially looking for it to go lower. Other terms that I talked about or I mentioned earlier are things like support and resistance. Support and resistance. Now, what are support and what are resistance levels? And this is really kind of goes back to supply and demand. But where are there points on a chart where, when you take a step back, that sellers tend to step in, or where buyers tend to step in? And I've drawn a couple of these on here. If you're looking at this chart, this is the S&P 500, and we can see at this lower level, this tends to be a level where you see support. Buyers tend to step in, and when it's at this level, for whatever reason, buyers tend to step in. And we see that. In fact, when we look further in the chart, we could see this it went up and it came all the way back down, and this support level held once again. In fact, it does it again all the way over here, a third time. And some people look at how many times does it hold support, and they tend to say, well, you're holding support, 3 times. On the 4th time, it might break. But looking for those support levels is important. Resistance is up above. Resistance are levels where sellers tend to step in. All right, and where do you see sellers stepping in? And you can sort of draw and see, where do sellers come in? And you can see that's resistance. Support is where buyers come in. Resistance is where sellers step in. Okay, and that is support and resistance. And you can use this when you take a look at different time frames. You can have different time frames on your candles. You could be looking at a different time frame for your chart. But in the end, you can potentially identify levels that can help you. Hey, if it, when this was trading down, you knew it was a support level down here. Would you have potentially wanted to take a chance and buy down in here, looking for it to turn higher? Yeah. You could have, and did you have to, you could have taken a profit anywhere in here and sold it anywhere along for a profit. You could have done it again back in here. Now, it's just a matter of trying to find where those supply and demand equilibrium points are, or where there's support and where there's resistance. Now, one support and resistance tool is Fibonacci. All right, now Fibonacci, you may have heard about Fibonacci. Fibonacci retracement is a tool that a lot of people use. Just a little history lesson on Fibonacci, and that is Fibonacci. It's a mathematical sequence. It's a mathematical sequence where it's a pattern that is actually seen in nature. It's something that you would see. It's a ratio. It's a ratio that you see where You see it in flowers. You see it in animals, like in snails. Da Vinci saw this ratio in the human body. We've actually replicated it in architecture, and it's just a ratio. It's simply a ratio, a mathematical ratio that forms in nature. And people say, well, if it forms in nature, potentially it's a pattern that would also form in the markets. And you can go look up what Fibonacci is. It's the way the sequence goes, and it is a ratio. You can draw these ratios on your chart, and people do use Fibonacci levels because there's so many people who look at it. They're looking for levels on retracements. And I will actually demonstrate this later, how you draw a Fibonacci, from a high to a low, and then where are levels that might become relevant in a retracement. When it turns around and starts to come back, where might you see levels where the price may pause for a bit before making a move, and it can help you identify potential entry and extra points as well. But I think that's one I'm going to hold for when I can actually show it to you on the platform. Now, when I go to the platform, we are going to be doing indicators and drawing tools. Now, when I talk about technical indicators, and this is just a snapshot from our platform, we have got a variety of mathematical technical indicators. There are a bunch of them in here. If you don't know what any of them are, we have in platform education, there's a little I with information, and it'll give you a brief discussion of what it means. If you want something further and really in depth, there are plenty of resources out there that can really break it down for you. I know that people use average true range. It's a mathematical calculation on what, based on volatility and standard deviations, what you might see for a range in an asset for a given day. What range might, how much might it move, and if it's making more than that, then it might catch your attention. Bollinger Bands around standard deviations, moving averages and reversion to the mean. There are a variety. Moving average, convergence, divergence. I mean, there are a bunch of different, and we put these on the platform. Again, I wouldn't say, hey, you need to learn all of these or you need to use all of these. In the end, the indicator that's going to be best is the one that you are most comfortable with, the one that that makes sense to you, that you know how to use, and where you're able to find success. Now, we also have drawing tools. With drawing tools, you can mark up your chart. Fibonacci retracement is actually a drawing tool, and you can put channels, you can put rectangles like I've done on my charts, you can put trend lines. I'm going to demonstrate all of this for you and show you how you can potentially use indicators and drawing tools on the charts at Nadex to help you with your decisions. Now, before I go into the practical demonstration, this is important. And so if your attention slipped, I'm saying pay attention right now, because this is very important. This is critically important when using technical analysis. So hopefully I've got your attention. And when we're talking about technical analysis, I'm going to tell you straight up, caveat emptor. Buyer beware. Buyer beware. In the industry, we also have another saying. Every ship on the bottom of the ocean had a chart room. So go take a look at the Titanic. Yeah, they had a chart room in the Titanic. And how did that work out for them? So, and the takeaway from that is that charts are not 100% accurate. They are simply a tool that at your disposal that could potentially help you. This is not the end all be all. This is not a crystal ball that's going to be to tell you exactly what's going to happen. The markets are going to do what the markets are going to do. What technical analysis does is it's a tool to help you in trying to make trading decisions. It's something that you use, and some people will often use one or two different tools, one to help them look at decisions and another one to maybe confirm that decision. But in the end, you have to be careful when you're using charts and always manage your risk. Managing risk is very important. Clearly, whenever you're doing trading, looking to make profits is what you're going for. But if you take yourself out of the game because you made a mistake and you didn't manage your risk, well, then you're out of the game. So managing risk is critically important. You can't just go and say, hey, the chart said this, and I'm going to wait until the chart's correct, because the chart might not be correct. They're not 100% accurate, but they certainly are a tool to help you in your thinking, in your decision-making process, both as an entry point where you might want to go long or short, but also as an exit, not just to take profits, because you also have to have an idea where you would want to take a profit, but also where you would, if you were wrong, how you manage your risk and stop your losses. I think I've answered all the questions as we've gone. If you've got any questions, for more questions, please email customerservice@nadex.com. Customerservice@nadex.com. I would also highly encourage you to follow us, not on all of those social media, but specifically on YouTube. And there's a reason why I'm going to mention YouTube, and particularly when it comes to technical analysis, which is what I'm going to show you right now. But please, any questions, email us. We are here to help. Now, every morning, if you're not aware, every morning we do a live stream on YouTube. If you're not catching those, this is the Nadex YouTube channel. There's a lot of resources on here for educational content. We had a boot camp. We're going to be doing another boot camp in January. I'm going to tee that up. It's going to be trading the stock market. But there's a lot of educational information in here. What I really want to point out are these past live streams and these upcoming live streams every morning with Brian Caprice from Keep Trading Simple at 8:45 a.m. Eastern. We do a live stream for 15 minutes, maybe 20 minutes, and we actually take a look and we do some live analysis for day trading. We look at hot spots in the market. What's the headline news? What's moving markets? Where are people focusing today? We do this at 8:45 a.m. Eastern, so it's before the open, 7:45 a.m. Central. We do this 45 minutes before the stock market opens, but we're able to take a look at what's going on. We'll do some technical analysis. We take a look at the charts. We can't make any trading decisions. We don't make any trading calls, but what we do is break down what's going on in the market, and we take a look at these hotspots where you might want to focus. If you want to go back and catch any of our past ones, you can watch them. Notice our upcoming live streams. I will be putting some on. Brian and I were going to be taking next week off, but I got to build them. We're going to be on next week, and then I've already got the first week of the year built out. But if you go and you come to the Nadex YouTube channel, you can simply subscribe, and then if you subscribe to a channel, there's a little bell icon to set reminders, and you'll know when we're going live. If you're not able to join us, realize that the recording is immediately available. So if you're not able to be there at 8:45 a.m. Eastern, but you're able to join, an hour later, go catch the recording. It's all available. We do that every morning, and I like to really emphasize this is a great resource on the Nadex YouTube channel. All right, we are now going to jump over to the platform itself, and I'm going to do that practical demonstration that I mentioned. I am not going to go through all of our platform features. We do sessions. My colleague Adam McCaden does a platform overview. He even does a session entirely on charts and technical analysis, where he will go through each and every one of the features. I am going to just do a quick demonstration. It doesn't matter which product I use, binary options, call spreads, knockouts. I'm just going to go ahead and choose binary options. I'm going to go click on indices, and let's just bring up a chart of, I don't know, we'll bring up the NASDAQ. Let's just bring up a daily chart of the NASDAQ. It doesn't matter what I bring up. I just want the chart populated. Oh, look, I even have, I have Fibonacci in here from a previous example. This is a 2-hour chart. Let's go to a 30-minute chart. You can choose. In fact, let me make this a little bit bigger. I'm going to make the chart a little bit bigger. Let's get rid of this. All right. Notice that you can, set the time frame. This is the time frame for each one of your candles. Do you want to be using 30-minute candles? Do you want to see 1-minute candles? I mean, if we're taking a look at very short-term trading, you can see we can get very granular. I'm going to use 15-minute candles. Okay. Now, You can also choose your time frame. How much do you want to see in here? Well, that's for 4 hours because I went to a week. Let's go back to 15 minutes and drop this down to a weekly chart. And by the way, I can scroll. I can scroll and choose my time frame. Notice I got my dates down below. All right, now I mentioned there were different types of charts, and I am going to go to types of charts just to demonstrate for a second. There's Heikin-Ashi, where notice that when it's trending down, every candle is red. When it's trending up, every candle. And so some people like to see that. To me, I like to see what's going on in each individual candle and make that determination for myself. But some people prefer to see that. There's a simple high, low, open, close chart where it's instead of a body, notice that there's a little notch for the open and close. I like the candlestick because I think it's just easier to see. I find it easier to see with the thicker body. Everyone can choose whatever suits them best. And I'm not going to worry about customizing or any of this. What I do want to show are some of these other indicators. So if you were wondering, for instance, about relative strength, we can drop that relative. If you're not sure what relative strength means, it's a momentum indicator, and it's telling you, hey, is it being overbought? Is it getting to a range where it's too high, where you might be looking for sellers to step in? Is it oversold, and where you might be getting to a place where buyers are going to step in? If you wanted to see relative strength, right now, according to relative strength, we are actually in the high end of the Nasdaq. This is not a trade recommendation, but where you would tend to see, it looks like it's overbought a little bit, and sellers might come in. Some people like to use that relative strength index. And, it's just one tool of many. You can modify, but it will come in with standard, the standard formatting. This is a 14-day period. Maybe you wanted to see it over 7. And the relative strength, I'll leave it at 70 and 30. But if you change that, you might get, look at this. Now it's way overbought. I mean, you'll see how these numbers change. If I use a period longer than 7, let's go up to 21. It brings the strength a little bit down, but it's still. And you can determine, hey, what determines strength? Is it above 70 or below 70? I can make it. You can make that determination yourself. So I'm just showing you. You can also display. Change how it displays so you can see it however you like to see it. So these are just an example of all the variety of indicators. We also have these drawing tools. For instance, if I were looking for a channel, all right, I'm going to actually draw a channel on here right now. We can see that we're in a bit of an uptrend. Let's try to draw this channel. You're going to see it, the extent of. All right, there we go. I've just done a channel where I'm trying to say, hey, when it hits the upper end of this channel, sellers tend to come in, and when it hits the bottom end, buyers tend to step in. We've been hitting this, we're right near the upper end of this channel. Now, again, this is on a 1-hour time period. See what happens if I drop this down to 15 minutes and zoom in. My channel doesn't quite fit as well, does it? So let's try to. I'm going to modify my channel a little bit. I think I could fix this. Hey, there's a little bit better at it. But again, you can see how adjusting your time frame might make a difference on how you set up your indicators. So if you were, right now, according to a channel, we're at the top end of a channel, and we're hitting relative. Let's put this back to 14 on the standard. We're hitting relative strength. Some people might say, hey, here's a selling opportunity. I'm not making a recommendation. I'm just saying this is how some people would read it. Now, I'm going to give you, let's go ahead and take these away. Let's just click on it and delete it. Let's get rid of relative strength. I'm going to click on the little X. I did say I was going to give you the I was going to show you how to draw Fibonacci because I know it's a very popular one. I'm going to go ahead and grab my drawing indicators, drop down to Fibonacci retracement. Again, if you're not familiar with it, it gives you a little bit of information over here. I'm going to click on Fibonacci retracement. Now, the way that you do a Fibonacci, since we were in a downtrend and we're retracing up, you start in the upper left-hand corner at the high, click once. I go down to the lowest point, and I click a second time, and then I drag it over to the right. Now what I'm looking at is each one of these levels. Notice how when this went down and came back, this 50% Fibonacci level, what's really rather interesting is now that I put it on, it kind of paused here. You know, it kind of got hung up here. But when it rallied back, after that sell-off, when it came back 50%, it had a hard time getting through that 50% retracement level. So this was resistance. And did it create opportunity? There was a little selling opportunity here. But when it started trending higher, some people jumped in and bought it. They might have gotten shaken out, but they might have been looking for it to retrace to the 50%, and then they got out of their trade and they're done. Now, these levels, once it goes through a level, all right, now it's gone through that level that was resistance, resistance, resistance. Remember, we talked about this as a resistance level. In fact, I'm going to draw it on here. Let's draw a rectangle. I'm going to say this was a resistance level. And we saw, I'm going to drag, there is a reason why I'm dragging it over. The reason I'm dragging it over is when you've got resistance, it hits 1, it hits 2, it hits 3. When it broke through that resistance level and started going higher, if we were to come back down, the way that some people would expect this is they would expect this then to be a support level, right? That if it came back down here, that buyers would tend to step in and be buying here, and you would see this be a support level, potentially a support level, where it might have a difficulty getting through to the downside. So, and that's how support and resistance works. When you break through a resistance level to the upside, it then tends to become support to the downside. And when you break through and let's copy this and duplicate it. When you break through a support level, which was right here, there was a support. It tends to be resistance to the upside, and it wasn't perfect. It wasn't perfect. It came up and it had resistance just before there. It had resistance again, and then the third time it came through and it broke through. So people do look at these Fibonacci levels to help them look for critical points where there might be support and resistance, and they use that with other indicators. It's not the only indicator, but again, it's a culmination of using maybe 2 indicators to help you out. All right, with that, I want to thank everyone for joining today. Hopefully you got a lot out of this. I showed you on our YouTube page. This video will get, this was recorded. You'll be able to go back and catch the recording. You'll find that in the videos section. It'll be dropped up here, and you'll be able to find it. Again, in our playlists or even in our videos, you can see upcoming live streams and past live streams. If you'd like to join, I would recommend come join us. And if you've got a question about what's going on, we do live chat. People can type in and get a little feedback and maybe even say, hey, do you mind taking a look at this or do you mind taking a look at that? We've been known to do that as well if it's one of the hot spots and what's potentially going on. But we've got a nice crowd of people who join every day. And again, it's a place for traders where they can congregate, see what's going on every morning and try to look for potential hot spots for the markets for that day. Again, any questions for Nadex, please email us, customerservice@nadex.com. I want to thank you for joining today. I want to wish everyone Merry Christmas. I know it's coming up this weekend. I want to wish you happy holidays if you celebrate one of the other holidays. I know Hanukkah already came and went. But we do have the new year coming up. So I want everyone to have a very safe and pleasant holiday season. Hopefully you will join us next week in the mornings. Brian and I will be doing those sessions in the morning, or otherwise we'll catch you in the new year. Good luck in the markets, everyone. And thanks again for joining.